Thank you very much. This is a terrifyingly large crowd. I was just downstairs getting a little bit of water before I went on today, and I was in the gift store and I saw a sticker that reminded me of being on this stage 3 years ago. And the sticker said, "Say nice things about Detroit." 3 years ago, I stood here, and after listening to some of your local and state civic leaders, I came up here and challenged everyone in attendance to say nice things about Detroit because I was so moved by their presentation and all of the great things that I heard happening that I wanted us to have perception become reality and to say nice things, and I committed the people in attendance to do that. Having spent 2 days in the city now, it is clear to me that lots of y'all have been saying nice things about Detroit, and I'm so happy to be back and to have a front row seat to all the great things that are happening here. Now, the reason that this is such a personal issue to me, to have you say nice things about Detroit, is because I am from a place that people don't say a whole lot of nice things about. I am from Alabama. Now, when you tell people, what did I just say? When you tell people you're from Alabama, a lot of people will say stuff like, "Well, it's great that you found a pair of shoes to wear today," or something to this effect. And so I like to lead out all of my presentations by featuring where I'm from. And in particular today, I'm going to feature Atlanta, because I am a son of the Southeast. The Southeast doesn't get much love, perhaps like Detroit, and I want to say nice things about where I'm from to start out my comments today. Now, I apologize if I had remembered that this would be during lunch. I might not have done this. Please put your fork down for a minute. You're going to see why. I'm here today to talk to you at lunch about parasites. We're going to talk today about guinea worms. We're going to talk today about guinea worms, a parasite common in Africa that is absolutely decimating, or has absolutely decimated parts of Western Africa. Now, the guinea worm, I'm not going to go into a gory description of it, but let's just say it's a nasty little parasite, and the way that you gain relief from this is by immersing your feet in water. The problem is, though, that so many of these African villages where guinea worms are common have a communal water source, have a shared water source. So someone becomes infected, it starts to burn and itch, they seek relief from this, they run down to the local watering hole to get some relief, and the whole cycle perpetuates itself again. Well, two groups in Atlanta, the CDC and the Carter Center, which is the philanthropic foundation having to do with President Jimmy Carter, are working to fight this. And in their efforts, they have done something that is unique in human history. Unique in human history. They have cured a disease, they have eradicated a disease for which there is no cure. There is no pill you can take to make this go away. There's nothing you can drink, there's nothing you can swallow. There is no medicine that is effective against guinea worms. And yet you see that over time they have taken this from millions of cases in the mid-'80s to less than 100 cases in the most recent year. How have they done this? They've done this by teaching the villagers a couple of simple behaviors, 2 simple behaviors. If you see something, say something. They basically taught them to rat out their neighbors so that if someone becomes infected, you shout it to the whole city so that now everyone knows who to look for, and then you work like crazy to keep them from that water source as a community. By teaching them 2 simple behavioral rules, they have eradicated a disease that was destroying economies and ruining lives. We ourselves in the retirement space, we in the retirement world are faced with another disease, another cancer, for which there is no and never will be a pill that we can take to change it. And that cancer that we face is bad investor behavior. I like to tell people And I hope that you will tell your folks, I hope that you will take this back to your organizations, your municipalities. God could not have designed a worse investor than you. Okay? God could not have designed a worse investor than you. Every impulse we have, nearly, is wrong. The only hope that we have is to follow a few simple rules and to work to turn some of those impulses on their head in ways that we'll talk about today. Because as you see the stats on the screen, you're probably familiar with many of these and those like them. We have a real problem here. Part of the problem is functional. We need more jobs. We need better jobs. We need higher paying jobs. But I tell you that even if we had all of those things, the problem that we have in this country with retirement would not be greatly impacted by this. Because studies show that even as people make more money, their behavior tends not to change and their consumption increases right alongside those better paying jobs. So let's talk about two handfuls of rules today that are going to help you and the people that you lead and the people that you serve become better investors. The first thing that we have to do is we have to take the power back. We have to take the power back. So many people are scared to invest because it's volatile, because of the vagaries of the financial markets, because of the uncertainty. Again, all of this is nothing that we as a human family are wired for. But we have to tell our folks that in all markets, up, down, and sideways, the first rule of behavioral investing is that you control what matters most. Okay? I have been on CNBC a number of times. And on my most recent trip to CNBC, I pledged to myself that it would be my last trip. Because when you're on TV, when you're on financial news, they put a little earbud in your ear, and it's really annoying. They have a director sitting in New York or London or whatever who's sort of barking things in your ear and telling you what to do, even as you can hear the host, and you're looking into a camera, right? You're looking into a camera and you can't see what's going on. It's hard to know what face to make. It's a very strange, disorienting experience. So on this last trip to CNBC, to be on CNBC, I had the director of the show count me down. She says, okay, we're on in 5, 4, 3, 2, don't be a nerd, you're on. Okay? What did she mean by don't be a nerd, right? Don't bore us with your boring behavioral stuff about how it doesn't matter what Donald Trump says, right? It doesn't matter what Donald Trump says. It doesn't matter what hurricanes are happening or what earthquakes are happening. It matters in humanity's terms, but it doesn't matter in terms of our course of action. Because in all geopolitical situations and in all natural disaster situations, you control what matters most. The research is unequivocal that a couple of boring, simple behaviors, like your ability to stay the course, your ability to set aside a little money every month, is a far better predictor of how that you are going to do than any of the big, sexy stuff we like to worry about and they like to ask me about on CNBC. So what she was telling me is, don't tell people this, don't give people the power, try and get them hung up on clickbait stuff, on stuff that sells headlines. Make a bold prediction, say something wild. Don't tell them that all you have to do is set aside a little money and try and maintain your composure, right? Because that's not sexy. But it is the truth. As nerdy as it is, you control what matters most. But just as someone who is taking on a new exercise regimen might need the help of a personal trainer, many times we can't do this alone. So I wrote a new book that was recently named the best investment book of 2016. And do you know why it was named the best investment book of the year? Because it was. That is why it was named. That is why. It's called The Laws of Wealth, and it better be sold out when I get off the stage. So I looked. So chapter 1 is called You Control What Matters Most. Chapter 2 is You Cannot Do This Alone. Okay? You cannot do this alone. Because just as we would all be skinny if we had someone to follow us around and slap those brownies out of our hands, right? We would all be rich if we had someone to help us and walk us through. So I want to show you 3 different studies that highlight different types of support. Some of the studies use just target date funds and computerized advice, robo-advice, impersonal online advice, and they still generate great results. Some use a one-on-one financial advisor. The type of help you get is not what I'm here today to talk to you about, but I am here to say that you need some sort of help, some sort of guide along this path. So here's the 3 studies. The first was done by Aon Hewitt. And serendipitously for nerds like me, it encompassed the 5 years of the Great Recession. Okay, it was a 10-year study, but it encompassed the 5 years of the Great Recession. Over the 10-year period, those who received financial advice in this study in the form of target date funds and computerized advice, so robo-advice, did 1.86% better than their peers who were just trying to go it alone. Okay, 1.86% better. This jumped, though, to nearly 4% during the 5 years of the Great Recession. So we need advice perhaps when we want it least. When things are really scary and really volatile out there, advice pays big dividends. Vanguard, you all know Vanguard, big, huge multi-trillion-dollar fund manager, index fund manager mostly. They did a study called Behavioral Alpha that talked about the power of good advice. And in this study, they found that people who received advice did 3% better per year than those who received no advice. But it's interesting that the power of this 3% came from an unexpected source. They found that only 35 basis points, or 35 1/100% came from the actual asset allocation. So the actual investment mix only accounted for about 1/3 of 1%. Whereas behavioral coaching, which in Alabama we call keep you from doing stupid stuff, right, accounted for 150 basis points, or 1.5% of that 3% delta. Okay? Again, the greatest power of advice is not in hiring a junior Warren Buffett to help you crank up your returns by a few percent a year. The greatest power of advice is to keep you from making 3 to 5 soul-crushingly stupid financial decisions over the course of your investment lifetime. Morningstar studies similarly found that people who get financial advice do about 2% better per year. But you say 2 or 3% doesn't sound like a big deal, Doc. I am here to tell you that it is a very big deal. Consider someone in their mid-30s with a 30-year time horizon, a starting account balance of $100,000, who puts aside $10,000 a year for the rest of her working life, for the next 30 years. If they get the average return, that accrues to most investors, they are going to she's going to end her working life with $1.25 million. Way to go. Great job. If she gets that extra 3% that research suggests can be had by simply reading a few good books, maybe working with a target date fund, working with an advisor, that extra 3% yields an ending balance of $2.5 million. Double the terminal wealth by just getting a little help along the way. But wait, there's more. But wait, there's more, because not only do you have a better outcome, you have a better personal outcome too. People who are receiving financial advice, whether at work or through an advisor, showed the following characteristics in a Canadian study. They had 3 times the global peace of mind. So global is the shrink word for sort of all-encompassing life peace of mind. This isn't just about money. They had 3 times the peace of mind of their peers. And it shows you just how central money is to our quality of life. Even things that have nothing to do on the surface with money are impacted by our worries about money. They were obviously 3 times as prepared for an emergency or retirement, but financial advice in whatever form it comes pays dividends both in your final account balance and in life. And it would seem that actually the hypothetical, it would seem that the hypothetical that I threw up earlier is actually conservative, because observed effects in Canada of people who receive advice shows that those who receive advice over a 15-plus long-term period, 15-plus years, have 273% the wealth of their no-advice peers, nearly 3 times the account balance of those who are going it alone. Getting advice makes you happier, it makes you healthier, and it makes you richer. All very powerful things. Which is why it is so damaging that Wall Street has misled us about the advice, about the benefits of working with financial professionals. Okay? A recent survey in Forbes found that financial professionals are esteemed as slightly less trustworthy than Congress people, which is just something else, and slightly more trustworthy than used car salesmen, right? Okay. And it's because Wall Street has mismarketed the impact of advice and investment advice. A recent study by a large fund manager called Natixis found that within the financial services industry, 83% of people in the industry say that the greatest value that we add is behavioral coaching, hand-holding, and keeping people from making bad decisions, becoming their own worst enemy. When they ask mom and pop investors, though, what the greatest value is, only 6% say that it's behavioral coaching. Wall Street has sold us this idea that the way to retire successfully is by cranking up returns, paying big fees, and by generating alpha, like outsized investment performance. But the research shows that where we really have the best impact and get the best outcomes is by understanding that we control what matters most and seeking out someone or something that is going to help us control that thing. Okay? The next rule that I want to talk about is that risk is not a squiggly line. Okay? Risk is not a squiggly line. This is a reference to the idea in financial markets. The way that we talk about risk in academia is volatility. The up and down motions of a stock is a proxy for risk. But I want us to reject that notion and to think about these things in more psychological, behavioral terms. So to do this, I want to introduce the story of a woman named Brooke, not her real name, who I met with. She was my first client ever. As a psychologist, because before I started working in the financial services industry, I was educated as like an honest-to-goodness, lay on the chaise lounge and tell me about your mom, Dr. Freud psychologist, okay? So Brooke was my first client ever. She walks in and she's beautiful. And I'm 23 and goofy. Now I'm 37 and goofy, but at the time I was 23. I had never seen a patient before. Beautiful woman walks in. Honest to God, I dropped all my papers. I'm like fumbling to pick them up like some bad movie. I get all my papers together and I sit down with Brooke and she presents me 6 envelopes. 6 envelopes. And I'm sweating because I'm like, this is not in the book. This was not in the chapter. I never read a 6 envelopes chapter about this, okay? So she hands me these 6 envelopes, and I go, hey, what's going on? And she says, all my life I've wanted to be a doctor. I've applied to 6 schools. I've heard back from all 6, and I cannot bring myself to open these envelopes because if I don't get in, I'm going to be heartbroken. It's too much. I can't take it. And so I, having recently been through the graduate school application process, I said, well, Brooke, surely you've got to get back to these folks pretty soon or else they're just not going to let you in. You've got to tell them whether you're coming or not. And she said, yeah, that's right. I have about 10 days for most of these programs. I have about 10 days to let them know. So I said, oh, great. Not only have I never heard of the 6 envelopes thing, we got to work fast here. Not exactly my specialty as a novice therapist. So the place that we got during that session, and I'm sure I didn't say it this articulately at the time, was I pointed out to her that in her best efforts to keep her life placid and calm and risk-free, she was actually bringing about the certain negative outcome that she was so scared about. That in her efforts at managing risk, she was actually bringing about a 100% chance that the thing that she was risking was going to happen, right? She was definitely not going to get into any of those schools if she didn't open those envelopes. So Brooke opened the envelopes, she got into all 6 schools, and thank goodness, because if she hadn't, I would have been done. I was all out of tricks. But she got into all 6 schools, and she learned this important lesson that sometimes by playing it safe, we can be doing the riskiest thing of all. So since March of 2009, the low for the market, right, I have had the opportunity to talk to a number of people who have waited and sat on the sidelines and keep waiting for that perfect moment to jump back in. So I want to give you a statistic that was staggering to me when I read it, and I think it will be to you too. So the average intra-year drawdown, which is nerd speak for how much the market goes down inside of any January to December in any given year, the average over the last 100 years has been nearly 16%. Okay? The stock market falls double digits basically every year. Okay? Basically every year. And in spite of that, you've seen these mountain charts with how well it has compounded wealth over this time. In spite of that, its ability to compound wealth over long periods of time is just unprecedented. Okay? Volatility is the norm. There is never a good time to invest. If you're waiting for a time that's free of earthquakes and tornadoes and hurricanes and political unrest, it will never come. And yet we see that markets do a great job over time. So within the spirit of Brooke, I want us to look at 2 different asset classes here, and I want you to tell me which feels riskier to you. So these were computed on what's called a 20-year rolling average, which means we take the average, say, from 1960 to 1980, then again from 1961 to 1981, 62 to 82, etc. And each one of those would become a data point. So in rolling 20-year periods, asset class number 1 won every race. It outperformed every single time in every single 20-year period. And it had an average real return, so that's in excess of inflation, of 7.4%. Asset class number 2 lost every single time, and had an average real return of 1.4%. Which one's riskier to you? Which one seems like the riskier option to you? A or B, or 1 or 2? 2. With the benefit of 2020 hindsight and presented dispassionately like this, 2 seems riskier. I mean, what else do you call something that underperforms all the time and has paltry returns? And yet, asset class number 1 is U.S. stocks, and asset class number 2 is bonds, right? And don't run home and tell people Dr. Crosby said don't invest in bonds. That's not what I'm saying here. What I'm saying is this. We are the greatest enemy to our success. We are the greatest enemy to our success. Our fears, right? Our tendencies to buy into fear and greed are our greatest enemies, not the up and down squiggly motions of markets. And sometimes in our very efforts to finesse it and time it and get it just right and avoid even a modicum of volatility, we can become our own worst enemy. The next rule is that we have to start now and start again tomorrow. The first reason for this is mathematical. If you start early, you can reach a very aggressive goal like $2 million with a relatively small annual allotment. If you wait even a couple of years, you have to really crank that up. Everyone gets that. Everyone understands the miracle of compounding interest. But what many of us don't understand is our ability to lock in good or bad behaviors early. And I hope that this lesson will help us take this back to our cities and our organizations, the need to teach children and the need to teach young employees and everyone about these behavioral tendencies early on. So this is an experiment called the free choice paradigm. Who likes art? Raise your hand if you love art, if you're a big art lover. Ma'am, what's your name? Patricia. Okay, Patricia is going to be my example here. I call Patricia a person of taste and sophistication into my office. And I say to her, Patricia, I have 6 impressionist pieces of artwork here. I want you to rate them from number 1 to number 6 in terms of your preference for them, right? Patricia does this easily. She loves art. She knows all about it. Ranks them from 1 to 6. I go back to my office, and I come back wringing my hands, and I go, Patricia, I am so sorry. We're out of number 1 and number 2 prints, which I was going to give you as a gift to take home. We're out of number 5 and number 6, so you will get a print to take home for participating in this experiment, but it's going to have to be number 3 or number 4, and I'm sorry, because you didn't love these, you didn't really hate them. They were sort of just your middling preferences. So Patricia takes home number 3, presumably, because she had a slight preference for it. And 2 weeks later, I pretend like my research was destroyed. Okay, I say, oh, Patricia, my computer broke down. We lost all the results. Can you come back in and rake those same 6 paintings for me again? So Patricia comes back in and goes through this same exercise, but this time the results are different. And I want you to think about what's happened. Okay, where's number 3 now? Shout it out. 1. Number 3 is now her favorite. Number 4 is now number 6. Okay, because what's happened in Patricia's mind? She says the choice that I took, the behavior that I engaged in, she spends that 2 weeks patting herself on the back for that. Because this is how we operate as a human family. We want to walk through the world feeling confident and self-assured and like we are people of above average intellect and good behavior. So if we make a choice, regardless of how good or not it is, we tend to applaud ourselves for that choice. But a second tape is playing in our minds the whole time. She is also tearing down the choice that she didn't make because she doesn't want to feel regret. Regret's one of the most powerful negative feelings that we have, and it is, some suggest, the most common negative feeling that we have. Patricia doesn't want to feel regret. So she beats up number 4. Number 4 sucked. I didn't want it anyway. It was ugly. It wouldn't have looked good with my couch or my curtains. She beats number 4 up. She builds number 3 up. If we can engage people in early financial education, we can set this process in motion, this 2-part process, where behaviors like saving and accepting the uncertainty of financial markets, which are so foreign to us as a human family, can become second nature. And we can actually get the people in our organizations to become evangelists for good behavior like this, but we have to start early. We have to make the process as simple as possible. I like to tell a story about simplifying the process that goes like this. There was fantastic research coming out of California in the 60s. I want you to think about where you would fall down on this today. Okay? Where would you fall down on this today? A group of California housewives was called up, and they were asked to take a 2-minute survey on their cleaner research. Mrs. Smith, we would like to talk to you for 2 minutes about what kind of household cleaners you use. Is that okay? Yes, that's fine. Okay? They talk for 2 minutes. 2 weeks later, because it's always 2 weeks in psych studies, 2 weeks later they call back and they say, Mrs. Smith, thank you for your commitment to a cleaner world. We would like to send a group of grown men to your home to dig through your cabinets to see what kind of cleaners you use. Is that okay? Most of them said yes. Most of them said yes. Why? Because they simplified. They started with a small ask, and then they worked towards something greater. When we're trying to get people to engage in a difficult behavior, like saving for retirement, investing more money, we have to remember in all of our organizational initiatives to start small. Get a little positive momentum rolling, and then ask for that next biggest step up the ladder. So the next one is trouble is opportunity. The next rule is trouble is opportunity. And this falls under sort of the duh rule, right? Because I sat on a plane recently. I fly a lot for work. I was recently on a plane, and I'm the kind of guy on a plane, even though I'm fairly extroverted and friendly elsewhere in life, on a plane, just don't. You know, just don't. Like, just let me put my headphones on and let's not. But the woman that was sitting next to me on the plane was not of the same mindset. And she immediately starts talking to me. Now, what's cool is when you are a psychologist who is also an asset manager, when somebody asks you airplane small talk like, hey, what do you do for a living? You've got one of two options. Okay? You can tell them you're an asset manager and know that they're going to leave you the hell alone for the next 3 hours. Or you can tell them that you're a psychologist and hear about every childhood trauma that has ever happened to them. So even with all of my tricks, I could not get her to leave me alone. And soon I'm telling her my life story, and I'm telling her, I get the tables turned on me. I tell her about my career, and she goes, wait a minute. She starts chuckling, and she goes, wait a minute. You went to 8 years of college and have written a number of books to tell people to buy low and sell high? Like, that's your job? And I was like, yeah, pretty much. And the reason that she got it wrong, and I don't have a silly job, lady, the reason that I don't have a silly job is this. It's like diet and exercise. Buy low and sell high is like diet and exercise, and we'll put it with phrases that everybody knows and no one does, okay? And this is why. I want to share two studies that I hope you'll really stick with you. These are both found in the Laws of Wealth. The first is a study from a liquor store. This liquor store was having trouble titrating sort of the flow of the various types of alcohol that they sold. And they said, man, we can't get our orders right. I wish we could get a little bit more clarity and a little bit more consistency on what types of alcohol are leaving the store. And so they tried an experiment. They tried playing different types of music to see how it would impact consumer behavior. When they played German music, the sales of German beer rose by over 50%. When they played French music, the sales of champagne rose by over 75%. Now think about this, though. If you ask Mr. Jones, who is leaving the liquor store, Mr. Jones, excuse me, Daniel Crosby here, student of human behavior, why did you decide to go with this case of German beer? Do you think Mr. Jones is going to turn to me and say, well, I was subtly influenced by my environmental cues, right? I can tell you that he will not. He will say, I don't know, it just sounded good, right? Just sounded good, right? All of these environmental cues impinge on us and influence our behavior in ways that we don't fully understand. And here is an even better example. Now, before you boo me, by the way, I'm going to make fun of Audi, okay? Don't think I'm going to bring foreign cars to Detroit and expect a good response, okay? Raise your hand. Now, this will be brave. These people will be brave here in the Motor City. Raise your hand if you drive an Audi and keep it up. Oh my God, no one, huh? Oh, one brave soul back here. Stand and be counted, sir. Tell me your name. Mark. Mark, who doesn't believe in buying American. Good job, Mark. Okay. Okay, so Mark, I have never, oh my gosh, usually when I speak, I get about maybe 5 to 10% of people owning an Audi. This is an America First crowd. I love it. Okay, except for Mark. Okay, so Mark the Audi driver. So Mark, listen well. Everyone look at Mark. A recent study found that Audi drivers, Mark, you married? Yes. How many years? 35 years. Don't clap? No. Stop it. You don't even know the punchline yet. Audi drivers are the most likely of any to cheat on their spouse. Mark, that's 35 years built on a throne of lies. You cheater. So Audi drivers are the most likely to cheat on their spouse, followed by BMW and then Mercedes. Okay? Foreign cars, man. No? Okay. So here's a non-rhetorical question. Why are people sleeping with Audi drivers and not Kia drivers? You laugh because you get it. Okay? Who drives a Kia? Oh my gosh, I'm sure you have a lovely sex life. No. Okay. The best predictors of marital infidelity are money, travel, and looks. Okay, it's like not shocking, right? People who have affairs are good looking, rich, and gone. Okay? So basically, the best predictor of marital infidelity is not professed ethics. It's not how many love languages books you've read. It's not your religion. It's none of these things. It's opportunity. We as a human family are profoundly impacted by the world around us, and we don't always account for this. Whether it's an Audi driver like Mark cheating on his spouse, or whether it's people in a liquor store buying beer for reasons that aren't entirely clear to them, we as a human family fail to account for the way that the externalities impinge on our behavior. So the lesson here is this. Listen, if you've said this, or if the people you serve have said this, oh, I hope there's another March of 2009, because I learned my lesson. And when we get another dip like that, oh my goodness, I'm going to be buying and buying and buying. Last time I sold, and that was silly, but now I know, because it's just straight up for 8 years after that woeful time. Shut up. No way. Okay? Everyone says this, no one does it. Because of this very simple fact. We lose 13% of our IQ when we're under stress. 13 studies show that we lose 13% of our IQ when we're under stress. Some of you don't have an extra 13, okay? Not everyone is running around with an extra 13 to just toss to the wind and still make great decisions, okay? We lose 13% of our IQ when we're under stress. This is why we have to automate these processes. If you walk away with one thing today, let it be automation. A meta-analysis, which is a nerd word for a study of all the studies, a meta-analysis of over 200 studies on adherence to simple automated rules versus PhD-level decision-making discretion, found that the simple automated rules win 94% of the time. The best thing that you can do for your investments is to lock them up, to lock in the process of escalating your contributions when you get a raise, to lock in the process of not doing anything, to lock in the process of throwing away that quarterly statement every time it comes, right? Lest you see those dreaded parentheses around some of the numbers, right? Lock in these processes. So, I told you from the outset that I'm from Alabama, which, as everyone knows, is a big soccer state, right? So let's have, wait, what? So let's talk about soccer here for a little bit. So a study was done on EuroLeague goalies. And they were looking at, this is big business over there, very big business. And so they're looking at the behavior of EuroLeague goalies and trying to help them improve. Study finds that EuroLeague goalies, when there is a shot on goal, basically engage in one of two behaviors. They dive dramatically to the left, or they dive dramatically to the right. Okay, 94% of the time. But shots on goal are divided equally, a third, a third, a third. So what happens? Well, the study found that EuroLeague goalies stop the most shots the 6% of the time when they stand still. And so they tell these folks, hey guys, you know what you should do when there's 1 billion people watching your game on TV and there's 120,000 fans screaming at you? You know what you should do? Just stand there. Just stand there. And you're going to stop a statistically significant higher number of goals. Do you think they took that advice? Absolutely not. Because we as humans have a bias toward action. We feel that when the game is on the line with our portfolio, we feel like 1 billion people are watching and 120,000 fans are screaming at us. But all of the research says that we should do less than we think we should. So a couple of quick studies, and then my favorite of the entire deck. William Sharp, Nobel Prize winner, found that you have to get your decisions right 82% of the time to match doing nothing, right? Hint, most people can't get there. Almost no one can get there. We also know that a vast majority of the returns of the market come a small minority of the time, which gave rise to the statement that what matters is not timing the market, but time in the market. And nothing drives this home more effectively than this study by Fidelity. Fidelity, big giant asset manager, custodian, they have access to all of these great retail accounts, and they say, for the benefit of people like Dr. Crosby, we are going to look at our retail accounts and we are going to isolate the behaviors that are consistently leading to the best investor outcomes. So we're going to look at people with killer returns and figure out, what are these guys doing? What's the secret sauce? So I'm going to let you in on their 2 findings. They found that people who performed the best fell into one of 2 categories. The first category, dead people. Dead people were the highest performers in the Fidelity study. The second highest performing group was people who had forgotten that they had a Fidelity account. Okay? Fidelity's grand study trying to isolate human behavior found that you should die or forget if you want to have really great investment outcomes. Okay? Nobody wants to hear this, but some of the things that investors push for, liquidity, transparency, regular reporting, are actually the enemy of good behavior. And in fact, I don't know if there are any fund companies or asset managers here, but if there are, I would like to pitch you on my fund. It's called the Behavior Management Fund. It will have a 60-year lockup where there will be no redemptions of capital, right? I will report your returns every 20 years. I will report those to you, and we'll keep the fees really low. So if anyone's interested, give me a call. We laugh, but we would all do very, very well in a fund just like that. Some of the things that we want, we don't really need because we need to do nothing or nearly nothing. The next thing we do that spurs bad investor behavior is that we look for certainty. We look for forecasts. Okay? Warren Buffett made big news this week, saying that he thought the market, the Dow, was going to go to 1 million by the end of this century. Right? But he's not the first person to make a big prediction about that. In fact, there was a book who was a super bestseller called Dow 36,000 that was published in 1999 that said that Dow 36,000 was right around the corner. Well, 18 years later, we're 2/3 of the way there, right? We're 2/3 of the way there 18 years later, which is why J.P. Morgan, the famous financier who was constantly hounded by the New York media, called a press conference after he was just bugged to make a forecast, to make a prognostication. He calls a conference and says, hey guys, I got big news for you about the market. Gather around, New York Times, New York Post, everyone come on, come get this juicy scoop. I'm going to tell you what it's going to do. He says 3 words, it will fluctuate. And he drops the mic and walks back to his mansion, right? Because this is what markets do. We're looking for a forecast for reasons I'm going to talk about in a minute, but first I want to tell you just how bad forecasting is, okay? Research out of UCLA found the 3 following things about forecasting. First, we found that the more famous the expert, the worse the forecast. Okay, so think about that. The more you have heard of someone, the less you should listen to them. Okay? The second, the bolder the past prediction, the worse the future prediction tended to be. So if you think about these first 2, it actually makes a lot of sense. Raise your hand if you saw The Big Short. Saw The Big Short. Many of you, right? Many of us. I saw it. I loved it. It was a great time, great, exciting movie, fun movie. What we don't see, though, is that there are no movies about what happened to those guys afterwards, right? Afterwards. The gentleman who made $1 billion on a single trade, John Paulson, who made $1 billion shorting subprime mortgages and was one of the sort of ancillary characters in The Big Short, talked about in the book at least, right? Not in the movie. John Paulson underperformed the market by 76% the next year. Okay? 76%, right? We never hear about what happens next. We just hear about the big improbable prophecy that comes true, but most of these people spend a lifetime banging that same drum, and it never comes true again, which is why learning that they were wrong did nothing to diminish the confidence these experts, quote unquote, had in themselves. In fact, their most common response is, I changed the world. I made a prediction, and it changed the way that markets work fundamentally. David Dreaman looked at over 78,000 consensus Wall Street forecasts and found that they were correct within 5 percentage points, right? Less than 1 time in 170. So think about that. They had less than a coin flip chance of directionality, just even getting up or down right. And then within 5% of the actual prediction, less than 1 time in 170. If every Wall Street analyst in the world walked into the Hudson River this afternoon, we would be no worse off as investors, okay? They just don't help. They give us reason to worry and not much help. So why do we listen to them then? I want you to remember this study, a study that was done using fMRI technology, where we hook the brains of investors up and we watch a brain scan. Using this fMRI technology, they observed people watching Jim Cramer. Okay, have you seen Mad Money? He's throwing plush toys at the screen. He's screaming and hitting buttons and loud noises. And they found something that could be considered kind of counterintuitive. This is a very loud, boisterous, in-your-face host, but they found in this fMRI study that people who are watching Mad Money, the part of their brain associated with critical thinking and decision-making goes to sleep. The part of your brain that's associated with making big decisions just goes to sleep. Your brain accounts for 2 to 3% of your body weight, but it accounts for about 20 to 30% of all of your caloric expenditure. So all the calories you burn in a day, your brain accounts, thinking accounts for about a quarter of that, right? About a quarter of that. So because it's so inefficient, because its energy spend is so much greater than its size, our bodies are always looking for ways to shut our brains down, frankly. We're always looking for ways to go into energy saver mode and to think less. But there are good ways to get that sort of energy saver mode, and there are bad ways. The good way is how we talked about earlier. Reading books, having a personal advisor, having a workplace program, something that gives you real, sound, personalized, individualized investment skills. The bad way is watching a failed hedge fund manager on TV throw toys at you, okay? We're always going to look for this. It's human nature to want to put this brain to rest. We just have to make sure we're getting tucked in the right way. So I don't want you to shout out or raise your hand or say anything. I just want you to write down or think about the first word that comes to mind. I want you to spell either on a piece of paper or in your head, I want you to spell the word die. Okay? Okay, so raise your hand if you spelled it D-Y-E. Okay, look around, keep them up. These are your friends. Okay, these are your good folks. These are your trustworthy folks. Thank you. Okay, now D-I-E. Oh, wow. These are your sickos. These are your weirdos. I bet my Audi man was among this group too, right? No. Right. So researchers have found that the way that we recall information has a lot to do with our affect or our emotion, right? And they find that the emotional state that we're in loads onto how we recall information. You ask someone who's having a great day, everyone here clearly, ask someone who's having a great day about their childhood, and they're likely to tell you about family trips to Lake Michigan, right? You ask someone who is having a horrible day about their childhood, and they're going to tell you how they got stuffed in lockers and got wedgied, right? Our emotional state has everything to do with how we assess risk and viability of a decision, which is why the next rule is if you're excited about an investment idea, it's a dumb idea, okay? If you're excited about it, don't do it, okay? There's a lot of exciting stuff going around right now, right? Bitcoin is the one that everyone's always asking me about right now. Very exciting, don't do it, okay? Very exciting, don't do it. And I'm not saying that Bitcoin's not going to go up. I'm not saying that it's not even going to go through the roof. It's just that we have to play these things like the house and not like a gambler. It's a great story that I love. Being a good investor is all about being a probability-based investor. Great story that I love by a gentleman, a baseball guy named Paul DePodesta. He tells a story about being at a casino with his buddy who is a little tipsy. They're playing blackjack. His buddy is showing 19 and wants to hit. Okay? And so DePodesta, who is sober, is like, bro, I am not going to let you hit on 19 in your drunken state, you dummy. You cannot do it. I'm not going to let you do this. As your friend, absolutely not. The friend waves him off. Nope, nope. I know what I'm doing. Dealer, hit me, hit me, hit me. Okay? The dealer hits, and what does he turn over? A 2. So the friend is insufferable now, right? The friend is jumping up and down. See, I told you I was right. And DePodesta has a line that should be the hallmark of all of your investing. You can be right and still be a moron, okay? You can be right and still be a moron. If you buy Bitcoin and it goes through the ceiling, you're a moron, right? I had a gentleman come up to me after an event like this recently, said, hey man, I got $1 million, half of it's in an index fund, half of it's in Apple stock. What do you think of Apple's prospects for the future? And I said, let's set that aside for a minute because you're a moron, right? Having that kind of risk is stupid even if it goes up. So let's talk about some exciting investing. IPO investing is exciting. Initial public offerings, new stocks, brand new stocks, right? Well, it's exciting, but they do worse than average, way worse than average, 3 years on. So the next time you hear about Blue Apron or whatever the exciting offering of the day is, just know that it might be right, but you're still a moron, because on average, it doesn't work. Another type of exciting investing is managing your account day to day, really staying on top of the moment to moment, minute to minute moves of the market. Very exciting, for sure, very exciting, very stupid. 1 in 360 day traders showed any skill in a recent Taiwanese study. And listen to this, daily looking at your account. Anyone know what the Robinhood app is? Has anyone seen this? Right? It's a free stock trading account, and I'm giving them free press here, but I'm going to tell you how bad it is. Robinhood did a study recently. It allows you to buy and sell stocks for free, which seems like a good idea. The average Robinhood app user checks his or her account 10 times a day. 10 times a day. I promise you, you can't check your account 10 times a day and do well, especially when it's free and there's no friction, because of the following. Harvard did a study of day traders, again with these fMRI machines. They said, we want to look at the brain patterns of day traders and try and line them up with a different group of individuals. Do you know what their brain patterns were the closest match for? People who smoked crack, okay? That's the closest brain analog to looking at your account 10 times a day. That is the crack smoking of investing, and it's not even investing, okay? There's an acronym from the addiction literature called HALT, right, from the 12-step programs that says never make a big decision if you're hungry, angry, lonely, or tired. And we could borrow some more adjectives here. The same principle applies to us. You should never make a decision in a fit of greed or fear or excitement. Good investing is so painfully boring. And so if you're excited about it, it's probably a bad idea. The next rule is that you are not special. And becoming a behavioral investor is fundamentally about understanding that you are prone to all the same foibles and screw-ups and biases and short-sightedness as everyone else. You are not different. Okay, I have written 4 books. A couple of them were mentioned up here. Personal Benchmark, New York Times bestseller, so proud, translated into Japanese. Laws of Wealth, best investment book of the year, translated into Chinese, Japanese, Vietnamese, so proud, selling like hotcakes. But I have written 2 other books that no one has bought. This is true. I wrote a book called You're Not That Great, and nobody bought it because it was super hard to gift. And honest to goodness, my publisher thinks I'm a moron. Honest to goodness, you can look this up. I really did write a children's book called Everyone You Love Will Die. It's heartwarming. Stop it. Has a good message, and no one bought that one either. So I'm very bought into this message of you're not special, right? And like the stuff that happens to everyone else is going to happen to you, right? Your loved ones are going to die, so make the most of today. Again, not a popular message. But we as a human race don't like these messages. That's why you laughed. You said, of course, Crosby, nobody's going to buy a book with those titles. We get that because we want to believe that we are different. So J.K. Galbraith, who studies financial bubbles, says there's 3 things that are the hallmark of every financial bubble ever. And they are brevity of financial memory. We forget about what it was like in 2009. We forget about how things can get ugly after 8 years of really great returns. The conflation of wealth and intelligence. Well, these Bitcoin guys are doing great. My neighbor has Bitcoin, and he just bought a Lamborghini, so there must be something to it. And then finally, the belief in something new in the world. Okay? In the internet bubble, this was the internet, right? Right now, it might be cryptocurrency. But all too often, it's us. We think that we are the something different in the world. We think that we are special or different or impervious to these things. And this is especially bad for men. Okay, this is especially bad for men are prone to this kind of overconfidence. A recent study found that 95% of men think that they are funnier than average. 100% of men, hundreds of people in this study, every single one, 100% of men thought that they were more interpersonally gifted than others. And 94% of men thought that they were more athletic than average, okay? So do the math on averages and think about these numbers. The researchers concluded it would seem that most men think that they are about 2 sit-ups away from dating a supermodel. Okay? But it's different. It's different with women because there's interesting research on women too, and it impacts the way that we plan for retirement. Okay? Women or girls at age 9 have the same confidence levels as boys. By age 15, they have 60% of the confidence of their same-age male peers. Right? The world has socialized them in a variety of bad ways, has told them it's all about looks, and has discouraged them from math and hard science and different things. The game has shifted, so women, the way that women and girls are socialized in our society, we find that women's confidence tends to flag as they age, which is why some organizations like Google have actually taken to giving nudges, pinging women, engineers, and requesting that they ask for a pay raise. Because the research shows that men will ask for a pay raise when they have just over 50% of the requirements listed mastered. Okay? Because the man's attitude is, well, they want me to do 6 things and I can do 3 of them and I can figure the rest out, right? But women on average wait till they have 100% of the skills mastered to apply for a promotion. So when it comes to talking about retirement savings, retirement preparedness along gender lines, the most common thing that we end up having to talk to men about is, hey, you're not as ready as you think. You're not as prepared as you think, and you're not accounting for some of the bad things that could happen or how long you might live or the sequence of returns risk or whatever. But that tends to be, as men, our oversight. We go, oh, whatever, we can figure this out, right? Women, on the other hand, often need to be coached that you don't have to be perfect to get started. As we see with the asking for a raise, a woman on average wants to wait until she has perfectly mastered the skill set to try and even dare to request to move up to that next level. So this is something to keep in mind personally and along our organizations as we think about where to go first. So I put these funny tickers up here because of this. These tickers are all examples of ones that were invested in heavily. Why? Anyone know why these would have been invested in heavily? Their names. Okay? So the research shows that people invest heavily in stocks with cute names. Okay? And some people think that markets are rational and efficient, right? People invest heavily in things with cute names. People underinvest in names, ticker names that are hard to pronounce. I share some research in the book that talks about an example at the tech bubble around the turn of the century. Everyone was going crazy for tech stocks. A company went public, okay? So a company has an initial stock offering. The company's name is Manatech. So Manatech stock over that first week gets bid up by 467%. You know what Manatech does? They make laxatives, okay? They make laxatives. Everyone just assumed it was some whiz-bang tech play because it had tech in the name. We are not special, right? We have to, at every turn, know that we fall prey to the same foibles and mistakes as everyone else, and we just have to automate the process of simple, good behavior. I told you about the gentleman with the $1 million account, half of which was in a single stock, Apple, who came up and talked to me. He was, by profession, a financial journalist. Okay, this is someone who spends all of his time writing and telling people what to do. I myself pay a financial advisor to take care of my money, even though I am myself a financial advisor and I would not have to incur that cost. I just know that I'm no different. I know that I can never go to enough school or write enough books to free myself of the fear and greed and insanity that comes along with being a market participant, and I know that I'm not special. So as we begin to wrap up, I want to talk to you about a concept called framing. So this is a fascinating concept in psychology, which shows that the way that we talk about something impacts the way that we think and behave around it. So research shows that if you ask most people, can you save 20% of your income? What do you think they say? Absolutely not. No way. Too much. I could never save 20% of my income. If you ask people if they could live on 80% of their income, what do they say? Yeah, that'd be okay. Yeah, that'd be okay. Retirement research shows the following. When you ask people, how long do you think you will live? Their average response is 85. When you ask people, when do you think you will die? Their average response is 75, right? So again, the way that we frame our discussions around investment management, around retirement, are profoundly, profoundly important in the way that they impact our decisions. So when we look at equity fund flows, it's a fancy way of saying is money coming in or out of stocks. So if we look at money coming in and out of stocks from 07 to 11, net, a lot of money is coming out of stocks, right? People are pulling money out of stocks coming and going because they're very scared. But there was one place where money continued to flow, and that was 529 accounts, so college savings accounts for kids. 529 accounts are great. There's tax advantages. There's all kinds of things. But when they drilled down and asked people, why did you continue to contribute to your 529 account when you were pulling money out of every other place? They said, I woke up in the morning, I looked at that kid, and I couldn't not do it. I had to. I looked at that sweet little kid, and I said, you are going to college. So I'm going to put my fear behind me, and we're going to make this happen. It's a great lesson in this. And I want to talk about one more example here, using two of my kids, not pictured as my 1-year-old, but here's two of my kids. And the lesson here is this. This is research from Personal Benchmark that showed that when people were shown a picture of their children before they made a financial decision, their savings rates increased 250%. When people just had to pause for a minute and think, what am I doing and why am I doing it? Sometimes investing can feel a little bit like playing a video game. It's just little dots up and down and, green and red arrows, and it's just, blips on a screen. But really, this is all about life. And the more closely we can tie our decisions to life, the better off we're going to be. So again, this Natixis study that I cited earlier is so damaging because it found that 76% of financial advisors said, yeah, my clients have a plan. My clients have goals and a plan. But they turn around and they ask these clients, hey, do you have a plan and do you have goals? 60% said no goals, 70% said no plan, and 80% of them said they go by their gut when making financial decisions. The thing that is missing is life. We are not connecting life back to these decisions. So as I wrap up, I'm getting the hook here, but as I wrap up, I want to tell you one final story. It's of Sir Isaac Newton here. Sir Isaac Newton, brilliant man, rich man in his day, very successful investor until he did one thing wrong. And that one thing ended in him dying penniless. Penniless. Because he looked around at his neighbors and he saw that his neighbors were invested in this speculative bubble company that was doing so well that they were getting richer than he was. He had enough money to last him the rest of his life. He was already very wealthy. He had already been a successful investor, but he couldn't sit by and keep up with the Joneses. And so he piled his entire net worth into this speculative company called the South Sea Company. And because he did, he lost everything and died a very smart but very broke man. Because as he said, he can calculate the movement of the stars, but not the madness of men. Adult learning theory says that after all this hour of talking, you're going to remember like 2 or 3 things. So I'm going to take that into my hands. It's probably going to be the Audi story too. So I'm going to take that into my hands and say that if you remember just 3 things from today, let it be these 3. Simplify the process. The Fed comes at us. The US Fed comes at us every year with 45,000 pieces of economic data. It's nonsense. We can't make sense of it all. And yet that we see that the best investors are dead investors or forgetful investors. Simplify your process at every turn. Personalize it. Let this personal benchmark concept work for you. Tie your life to your financial decisions, embed your values within there, and then finally automate it. Automate the process of making those great decisions so you won't be like someone buying beer at a store who's subtly impacted by things that are beneath their awareness. Again, it has been my pleasure. I'm so grateful that you had me back. Thank you for your time and your kind attention.